Okay, so you're here because you want to like really get Forex trading, right?
Yeah.
But without, the typical like high risk, crazy stories, right?
Yeah, we've all heard those.
We've all heard them, and honestly, sometimes they can be a bit off-putting, right?
Exactly.
So today we're going to be doing something different.
Yeah.
We're going to be exploring these kind of like lesser known but potentially much safer Forex trading methods that emphasize things like capital preservation, consistent gains,
Yeah.
and just kind of moving beyond the typical like super aggressive strategies and the super complicated technical indicators
Right.
that sometimes just make things harder than they need to be, right?
Yeah, I think so.
So we're going to be diving into an article that really caught our attention, and the title says it all. The safest Forex trading methods brokers don't want you to know.
Absolutely.
So this is going to be a fun deep dive, I think.
I think so too.
All right. So let's kick things off with this first method, the market making approach. Now, when we think of Forex trading, we typically think of somebody sitting there staring at a screen, trying to predict if a currency is going to go up or down, right?
Right.
But this approach, this market-making approach, asks us to shift our perspective a little bit and think more like those big banks and institutions, the market makers themselves.
Yeah.
What's the fundamental idea behind this?
Well, I think the most fascinating thing here is exactly that shift in perspective.
Yeah.
You're not just, trying to just react to little price ticks. You're trying to like understand how market makers actually make money.
Right.
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 And their primary income comes from something called the spread.
Right.
And that's just that tiny difference between the price they buy at and the price they sell at.
Right.
And they also use some pretty complex hedging strategies to manage their own risk because obviously they're dealing with huge amounts of money, right?
Of course, yeah.
And while we can't, completely replicate what they're doing on their scale,
Right.
we can definitely adopt some of those underlying principles to our own trading.
So how does that actually translate to practical steps for, the average trader, right? What can someone actually do differently?
So the article highlights a few key ideas, and the first one is trading with the spread.
Okay.
Now, think about it. At the open of a trading session,
Yeah.
there's usually a lot more uncertainty, right?
Right. Yeah. There's less agreement on what the price should be.
Less agreement on price, yeah.
Yeah.
So this is where the market makers, they widen that gap between the buyers and the sellers to profit from that initial like flurry of activity.
So they actually make more money during those periods of higher volatility.
Exactly, yeah.
Interesting.
And by looking to enter trades when those spreads are typically wider, which is often those session opens, right? You're essentially taking advantage of that rather than trying to like perfectly predict the immediate direction.
So it's less about being the first one in and more about positioning yourself in those periods of kind of like maximum uncertainty in a way.
Exactly.
Interesting.
It's a more nuanced way to enter a trade.
Okay, I like that.
The second principle is something called liquidity hunting.
Okay.
And this is where it gets really interesting.
Okay.
This is about understanding that there are these clusters of stop-loss orders.
Right.
Just beyond like obvious support and resistance levels. And, sometimes market makers, they might trigger those deliberately
Oh, wow.
just to generate volume.
Right.
And then they'll quickly reverse their position.
Oh, wow. So they're kind of like manipulating the market in a way.
In a way, yeah, it sounds a bit Machiavellian.
It does. Yeah. Okay.
But the idea for us is to try and identify those areas
Right.
where those stop losses might be clustered
Yeah.
and then consider taking a contrarian trade
Okay.
based on those potential liquidity sweeps, as they're called.
So it's almost like you're trying to anticipate the moves of these bigger players.
Yeah, exactly.
But isn't there a risk of getting caught up in one of those sweeps yourself?
Absolutely.
I mean, how do you tell the difference between like a genuine liquidity grab from the market maker and just like random market noise that could trigger your trade too early?
That is a crucial question.
Yeah.
It's not about just betting against every single move
Yeah.
beyond a key level.
Right.
It's about looking for confirmation.
Yeah.
So, perhaps a really rapid move followed by an immediate rejection,
Okay.
which you might see as like a long wick on a price chart.
Okay, so explain what a wick is for people who might not be familiar with that term.
Yeah, so if you're looking at a candlestick chart, you'll often see a sharp, thin line extending above or below the main body of the candlestick.
Right.
That's the wick. And that often indicates a price movement that was quickly rejected. Right.
Interesting.
It's like a quick surge and then it's pushed back.
Gotcha.
And the third principle is layered entries and exits.
Okay.
Now, instead of placing one huge order, you might use a series of smaller limit orders to gradually enter or exit a trade at different price levels.
Right.
And this is kind of how a market maker would do it.
Oh, so they're not just doing one big trade, they're spreading it out.
They're spreading it out, yeah, so they don't disrupt the market too much.
Interesting. So it's about being more gradual rather than trying to time that one perfect entry or exit point.
Yeah, exactly.
Like you said before, it's about thinking more like a facilitator of these orders rather than that speculator trying to get the very top or bottom of a move.
Exactly. You're becoming more sophisticated.
Yeah.
You're moving beyond just reacting to price.
Right.
You're understanding those underlying mechanics that actually drive those movements.
I like that.
Yeah.
Okay, so the article also talks about something called statistical arbitrage on minor currency pairs.
Right.
And I'll be honest, that sounds...
It sounds a little intimidating.
Yeah, a little intimidating, maybe even a little bit complicated.
Yeah.
But let's break it down. What is the basic idea of state arb?
So the fundamental idea is you're looking for assets that are mispriced.
Okay.
Relative to their historical relationship.
Mm-hmm.
And you're basically betting that they'll eventually revert back to that average, right?
Right.
Now, for the individual trader, the article suggests a slightly more accessible approach,
Okay.
focusing on minor currency pairs.
So why minor pairs specifically?
Well, often the major pairs, like, Euro IDD or GBP JPY,
Yeah.
they're so heavily traded and watched that any mispricings are very, very rare, and they're corrected so quickly.
Right, yeah, just the volume of trading is so high that it kind of takes care of itself.
Exactly.
Okay.
Whereas the minor pairs, with their lower liquidity and less, kind of like market scrutiny, they can offer some temporary deviations from their established correlations.
I see. So it's almost like these smaller pairs are a little bit more under the radar.
A little bit, yeah.
Okay.
And that's where the opportunity might lie.
So how do we actually spot these temporary discrepancies as individual traders?
Well, key is to look for pairs that have historically exhibited a low correlation.
Oh, okay.
Meaning they don't consistently move in the same direction.
All right. Yeah.
Think of it like, how often two things move in the same way.
Right.
If they have a high positive correlation, they tend to go up and down together.
Right.
Low correlation means they move more independently.
Yeah.
We're looking for those pairs that usually don't dance in lockstep, but might be doing so temporarily.
Okay, so it's almost like they're out of sync with their usual pattern.
Exactly.
Yeah.
And then you watch for instances where they suddenly start moving in the same direction much more strongly, which is called convergence.
Okay.
Or they diverge significantly when they historically haven't.
Okay.
And the article also mentioned this basket trading approach, which involves taking offsetting positions in those related pairs.
So you're kind of hedging your bets in a way.
You're hedging. Yeah, exactly.
Right.
So if you believe two negatively correlated pairs have diverged too much, you might buy one and sell the other.
Yeah.
Right.
Betting on that historical relationship to kind of like reassert itself.
So it's less about predicting, if the euro is going to be strong or weak against the dollar.
Right.
It's more about noticing if the usual relationship between, say, the Australian dollar and the Swiss franc is like out of whack.
Exactly. And importantly, the article stresses analyzing macroeconomic events.
Right. So you need to understand what's going on in the world.
Absolutely.
Yeah.
Is this unusual convergence or divergence due to just short-term market sentiment? Or does it reflect a larger, more fundamental shift in those economies?
So it's not just looking at the charts.
No, it's not just technical analysis.
You have to look at the bigger picture.
Exactly.
Okay, so this is definitely more on the advanced side of trading.
Yeah, it is more sophisticated.
But it offers a potential edge by focusing on those statistical probabilities and historical relationships rather than just pure guessing.
Right. It's more data-driven.
Yeah.
I like that.
Yeah.
Okay, so building on this idea of understanding those market mechanics, the article then goes into another really fascinating approach called forward contract simulations for swing traders.
Right.
Now, the article points out that as retail traders, we don't usually have access to forward contracts.
Yeah, those are usually for the big institutions.
Exactly. So how do we go about simulating their effects?
Well, the key insight here is that we're not literally trading forward contracts.
Right.
We're mimicking their characteristics.
Right.
A forward contract is essentially a custom agreement to buy or sell an asset at a specific price on a future date.
Right.
And their pricing incorporates things like interest rate differentials between the currencies involved.
Right, okay.
Now, for swing traders, who typically hold positions for a few days to a few weeks, we can achieve a similar kind of balancing effect by looking at correlated currency pairs.
Okay.
So, for example, let's say you're considering going long on Euro USD.
Yeah.
You would also analyze the broader economic fundamentals of both the Eurozone and the U.S., and then maybe consider a smaller offsetting position in another European currency pair that has a similar risk profile to kind of manage your overall exposure.
So you're not putting all your eggs in one basket.
Exactly.
Even if those currencies are like tightly linked economically.
Yeah, it's about diversifying your risk.
Okay.
The article also emphasizes multi-time frame analysis to make sure your swing trades align with the bigger, longer-term macro trends.
So you're not just looking at the short-term chart.
No, you need to understand the overall direction.
Yeah.
And then there's the carry trade aspect.
Okay.
Focusing on pairs with favorable interest rate differentials.
Right.
So you're earning a bit of interest for holding the position.
It's almost like getting paid to hold.
Kind of, yeah.
I like that.
While it's not a direct simulation of a forward contract,
Yeah.
it does incorporate that interest rate dynamic into your strategy.
Okay, so it's about thinking beyond just the immediate price action.
Exactly. Thinking more strategically.
Okay, so the next method is called trading the imbalance window.
Right.
And I gotta say, that sounds really intriguing.
Yeah, it's like finding a secret window.
Yeah, like a little crack in the market's armor.
Exactly.
So what is this imbalance window?
So this term refers to specific times during the trading day
Okay.
when major trading sessions overlap. And most notably, this happens during the transition between the London and New York sessions.
Right, because those are two of the biggest.
The two biggest, yeah.
Yeah.
And during these hours, you get these big shifts in liquidity and order flow.
Because different players are coming online and offline?
Exactly. Different institutions are becoming more active.
Right, okay.
So the market's kind of in flux.
So where's the safe trading opportunity in all that chaos?
Well, the article says to carefully observe those liquidity shifts.
Okay.
You look for what are called exhaustion points.
Okay.
These are often characterized by a really rapid, short-lived price movement. Like you might see a price spike up that gets immediately rejected, leaving behind a long wick on the chart.
Right.
This suggests that big institutions have stepped in.
Right, to kind of absorb all that buying pressure.
Exactly. They've absorbed the liquidity and pushed the price back down.
So it's almost like a fake-out breakout.
It can be, yeah.
Yeah.
And the idea is to enter a trade after this exhaustion has occurred in the direction of that reversal.
So you're kind of waiting for that initial frenzy to die down.
Exactly.
And then you're seeing where the market really wants to go.
Yeah, you're following the smart money.
Interesting. Okay.
The article also suggests using time-based exits instead of those strict price-based stop losses to avoid getting stopped out by those normal fluctuations that happen.
Right, because it's such a volatile period.
Exactly. It's very volatile.
So you need to give it a little bit more breathing room.
Exactly.
Wow, so it's like you're peeking behind the curtain during these transition periods.
Yeah, it's a glimpse into the institutional world.
Yeah, and you're seeing what the big players are actually doing. Not just what the price chart shows on its own.
Exactly.
It's about spotting those moments where their order flow leaves a temporary footprint.
Precisely.
That's really fascinating.
It is, isn't it?
Okay, so the next method is called the passive hedging method.
Okay.
Now, we all know about stop losses, right? Or kind of like emergency exit strategy.
Exactly.
But this passive hedging sounds like a totally different approach to managing risk.
It is, yeah.
So tell me more about it.
So traditional stop losses, they're a fixed price point, right?
Right.
You automatically exit the trade to limit your losses.
Yeah, cut your losses short.
Exactly. Passive hedging, on the other hand, involves taking a position in a correlated but different asset to offset potential losses in your primary trade.
Okay.
So the article gives a great example.
Yeah.
Let's say you have a long position in Euro USD.
Okay.
You're betting the euro is going to go up.
Yeah.
You might take a smaller short position in GBP USD.
Okay.
Betting the pound will fall against the dollar.
Right.
Because these two pairs often move in the same general direction.
Right, because of their economic ties.
Exactly.
Yeah.
So if Euro USD starts to decline,
Yeah.
GBP USD might also decline.
Okay.
And your short position there would kind of cushion the blow.
So you're not losing as much.
Exactly. You're limiting your downside.
Okay, so it's like a built-in safety net.
It is.
Yeah. I like that.
The article also talks about options-based protection,
Okay.
using things like CFDs or futures,
Right.
because direct Forex options aren't always available to retail traders.
Right. Yeah, those can be a bit trickier to access.
It can be, yeah.
Yeah.
So CSDs and futures, they let you speculate on price movements without owning the underlying currency.
Right.
So it's a bit more accessible way to manage risk.
Okay.
And then there's scaling into hedged positions.
Mm-hmm.
So instead of having that rigid stop loss
Yeah.
or a fixed hedging ratio,
Mm-hmm.
you adjust the size of your hedge as the trade progresses.
So you're kind of actively managing it
You're actively managing it, yeah.
based on how the trade is performing.
Exactly. So if your long USD position is moving in your favor,
Yeah.
you might reduce the size of your GBP/USD short hedge,
Right.
and vice versa.
So it gives you more flexibility.
Exactly. It's more dynamic.
Yeah, it's not just set it and forget it.
No, it's an ongoing process.
Okay, so that's a lot more nuanced than just placing a stop loss and hoping for the best.
Absolutely.
It's about constantly assessing and adjusting your risk.
Precisely.
Okay, so the second to last method is trade delayed confirmation zones.
Okay.
And this one really speaks to me because it's all about patience in trading.
It is, and patience is so important.
It is. It's something we hear all the time, but it's so hard to do.
It's really hard.
Especially when you're looking at the charts and you see the price moving.
Yeah, you get FOMO.
Yeah, you get that fear of missing out.
Exactly.
So what is this delayed confirmation all about?
So instead of jumping in right away,
Yeah.
when you see a breakout above resistance
That's right.
or below support,
Yeah.
you wait for more evidence that the move is real.
Okay.
This reduces the chances of getting caught in a fake out.
Right, because those happen all the time.
They happen all the time, yeah. So the article talks about reaction zones.
Okay.
These are price levels where historically the price has struggled to break through.
Right. So like those key support and resistance levels.
Exactly.
Mm.
We've all seen those on the charts.
Yeah, where the price bounces off repeatedly.
Yeah, like it's hitting a wall.
Exactly.
And the delayed confirmation can come in a few different forms.
Okay.
One is time-based confirmation. So you might wait for the close of a candle, like a 4-hour candle,
Right.
above that resistance level
Okay.
before you even consider going long.
So you're making sure it's not just a quick spike.
Exactly. You're filtering out the noise.
Oh, I like that.
And then there are second retests.
Okay.
So sometimes that initial break,
Yeah.
it fails.
Right.
But if the price comes back,
Mm-hmm.
tests that level again,
Yeah.
and breaks through and holds,
Okay.
that's a much stronger signal.
So it's like that second attempt is more likely to be the real deal.
It is, yeah.
Okay, so it's about increasing your probability of success
Exactly.
by waiting for more concrete evidence.
Yeah, you're looking for confirmation.
Yeah, it's like that old saying, measure twice, cut once.
That's a good analogy.
Okay, so finally we have institutional order flow tracking.
Right.
Now this sounds like we're trying to crack the code of the big players.
Yeah, we're trying to understand the smart money.
Yeah, see what they're up to.
Yeah.
So how do we even begin to do that?
Well, we obviously don't have access to their trading desks,
Right.
but there are some publicly available resources
Okay.
that can offer valuable clues.
All right, like what?
One is the Commitment of Traders reports, or COT reports.
Okay.
These are released regularly,
Mm-hmm.
and they show the net long and short positions of big traders in the futures markets.
Okay.
Now, while this isn't specifically Forex data,
Right.
it gives you an idea of the sentiment.
Yeah, it gives you some insight.
Exactly.
Okay.
Then there are volume profiles.
Mm-hmm.
These charts show trading volume at different price levels.
Right.
So you can identify areas where there's been significant buying or selling.
So you can see where those big players have been active.
Exactly.
Interesting.
And lastly, monitoring central bank actions and statements.
Of course, that's huge.
It's huge, yeah.
Yeah,
They can really influence the currency markets.
absolutely.
So it's about piecing together this information.
Putting together a puzzle.
Yeah, it's like market detective work.
I like that.
Yeah.
So instead of just looking at price charts in isolation,
Right.
we're trying to understand those bigger forces at play.
Exactly.
And how the big players are responding.
Mhm.
So looking at all these methods together, it seems like there's this whole other world of Forex trading
There is, yeah.
that's not just about high leverage and super fast trading.
Right. It's about being more strategic,
Yeah.
more thoughtful.
These approaches emphasize things like risk management,
Absolutely.
deeper understanding of the market,
Yeah,
and even anticipating the moves of those big institutions.
precisely.
It's a different way of thinking about Forex.
It is. It's more holistic.
I like that.
Yeah.
So I think the key takeaway here is that there are safer and more sustainable ways to trade Forex.
Absolutely.
It's not all about gambling and taking huge risks.
No, it's about preserving your capital,
Yeah.
having a balanced approach, and making informed decisions.
So for you, the listener, think about this. How could you incorporate just one of these methods into your own trading?
Yeah. Even just one could make a difference.
Yeah, it could change your whole perspective.
It could.
And how much more could you learn by diving deeper into those institutional patterns and market structures?
There's always more to learn.
There is. That's the beauty of it.
Yeah.
Thanks for taking this deep dive with us.
It's been a pleasure.
It has. I've learned a lot.
Me too.
All right, we'll see you next time.
See you then.